Welcome back to The Explainer. Today, we're basically putting on our detective hats to demystify ACCA Advanced Audit and Assurance Batch 3 topics. We are moving way, way beyond basic auditing today. We're stepping into those complex, high-risk scenarios where your professional skepticism isn't just a nice-to-have skill, it's literally your most critical tool. If you want to pass this exam, you've got to think like an audit partner, and that's exactly what we're going to practice right now.
We've got a packed lineup for our investigation today. We're hitting value for money, estimates and fair value, auditing related parties, handling subsequent events, and finally, going concern assessments. Let's jump right in. Section 1, Value for Money, or VFM. Our first stop shifts our focus over to the public sector. Unlike corporate audits, where we're mostly obsessing over profit margins and financial statements, here we're investigating performance. Specifically, how well do government programs actually utilize their funding?
As an auditor in this space, you really aren't just checking the math. You're evaluating what we call the 3 E's. First step, economy. Are they minimizing their input costs? Think about the cost per unit. Second, efficiency. Are they squeezing the maximum possible output out of every single pound spent? And finally, effectiveness. Are they actually hitting their stated targets? You'll be evaluating all of this using KPIs and benchmarks.
So, if you take away just one thing to cement in your memory for public sector scenarios, make it this. VFM equals economy, efficiency, and effectiveness. Oh, and remember, you're likely going to be providing negative assurance here, basically stating that nothing has come to your attention to suggest these 3 E's aren't being met.
All right, moving on to Section 2, estimates and fair value. These 2 areas are going to seriously build out our detective toolkit as we tackle ISA 540 and IFRS 13. Why? Because they are heavily prone to management bias. They require high judgment valuations, not just simple, hard facts.
Listen, your internal threat radar should be absolutely blaring right now. Management bias is a massive risk. You've got to independently challenge their assumptions. Are they using consistently over-optimistic growth rates just to inflate their asset values? Have they suddenly made unprompted, completely unjustified changes to their methodology just to hit a bonus target? You cannot just accept their word for it. You have to investigate. Now, IFRS 13 handles fair value through a really strict hierarchy of evidence. We drop from level 1, which is the gold standard, highly reliable quoted prices in an active market like stock exchange prices, down to level 2, which relies on observable inputs like standard interest rates. But the real danger zone, that's level 3. That relies entirely on highly risky, unobservable internal data generated by the entity itself. Because level 3 is essentially management doing their own math behind closed doors, we must aggressively investigate. You can't just tick a box here. You have to evaluate the appropriateness of their valuation models. You need to run sensitivity analysis. What happens if their assumptions are even just a little bit off? And most importantly, because these inputs are so complex and unobservable, you almost always need to bring in your own independent valuation specialist. So, lock this one-line cheat code into your mind before the exam. Whenever estimates, provisions, or unobservable fair values pop up in a scenario, your response should be automatic. You test their assumptions, you hunt ruthlessly for management bias, and you call in the external experts.
Okay, Section 3, auditing related parties. Let's crack open the case file on ISA 550. The primary risk here isn't a simple calculation error. It's hidden, non-arm's length transactions taking place between connected entities, like a parent company and a subsidiary, or maybe a director and the business.
So, how exactly do we uncover these relationships if management is deliberately trying to sweep them under the rug? We can't just trust the general ledger or the initial list management hands over. We've got to dig so much deeper to ensure completeness.
You must actively investigate, read through the board minutes, cross-reference the contracts, and scrutinize the share registers to spot any of those hidden connections. Once you actually find a related party transaction, you have to test it against the open market to see if it was legitimately priced at arm's length. And finally, you absolutely must get management on the record with written representations confirming they've disclosed all related parties to you. Make sure you remember this punchline. The hunt is always twofold. First, you're searching for hidden connections to ensure completeness, and second, you're looking for shady sweetheart deals that don't match up with market prices. Oh, and if there's no documentation for a transaction, you need to start considering the risk of fraud. Moving into Section 4, handling subsequent events. We are now entering the completion phase of the audit with ISA 560.
Here, we're basically acting as time-traveling detectives to figure out exactly how to handle massive events. Think a warehouse fire or a major customer going bankrupt that happen after the year-end date but before the financial statements are published. The timeline here is critical to understand. From the year-end date right up until the exact moment you sign that audit report, you had an active duty to hunt for new evidence. You've got to read post-year-end minutes, review management accounts, and ask about new litigation. After you sign the report, that active duty ends. But if you happen to stumble upon something before the statements are officially issued, you still have to discuss it with management. Understanding these two concepts solves the ultimate exam trap. How do you actually treat the event? It's pretty simple once it clicks. If the root condition existed before midnight on the year-end date, say a customer who was already struggling finally goes bankrupt in January, you go back and actually adjust the numbers in the financial statements. But if it was a brand new disaster that arose after year-end, like a factory burning down in February, you do not change the numbers. You only disclose the event in the notes.
Commit this single sentence to memory so you never stumble on the adjusting versus non-adjusting rules again. You have an active duty until the audit report, and you only adjust for what already existed. For the brand new stuff, you just disclose.
All right, final stretch. Section 5, Going Concern Assessments. Under ISA 570, we are dealing with the ultimate corporate nightmare, a company teetering on the brink of collapse. Assessing going concern is easily one of the most high-stakes judgments you will make as an auditor.
The standard is super strict on this timeline. We are looking at survival for at least 12 months from the reporting date. If you spot red flags of distress, things like loan defaults, bleeding cash flow, or the sudden loss of a major supplier, you cannot just nod along with management's rosy survival plan. You must rigorously challenge their cash flow forecast, test their assumptions, and figure out if their refinancing plans are actually living in reality.
Think of this as your ultimate cheat sheet for formulating the audit report. If the company is facing a material uncertainty, but management has been totally transparent and adequately disclosed it in the notes, you give an unmodified opinion, but add an emphasis of matter paragraph to point the user directly to that note. However, if management tries to hide the crisis with inadequate disclosure, you've got to hit them with a qualified or an adverse opinion. And if there are multiple, massive uncertainties everywhere, you just issue a disclaimer of opinion.
This one-liner perfectly resolves the whole going concern mystery. It gives you the exact reporting flow for applying the standards to a struggling client. Seriously, write this down because knowing this cold is practically guaranteed to save you marks on exam day.
As we wrap up today's explainer, I really want to emphasize the overarching theme of advanced audit and assurance. To pass this exam, you can't just be an accountant who simply adds up columns of numbers. You must act as an investigator. You've got to actively question the evidence, push back on management bias regarding estimates, hunt down those hidden related parties, and make the tough calls on whether a company is actually going to survive.
That mindset shift, that's exactly what takes you from a passing grade to an excellent one. So the next time you sit down with an exam scenario, ask yourself, are you just going to blindly read the numbers, or are you actually going to interrogate them? Keep that professional skepticism sharp, guys. Happy investigating.
Okay, picture this. You're about to sign your name to a piece of paper. But this isn't just any piece of paper. It's a document that literally dictates the financial fate of a billion-dollar company. Pretty heavy, right? Well, welcome to this explainer. Today, we are unpacking the incredibly high-stakes world of the auditor's report and governance communications. We're going to break down exactly how an auditor officially communicates their findings, starting from the most public-facing documents and pulling back the curtain all the way to the private boardroom. Let's dive in.
So, here's our game plan. We're going to cover the core opinion, key audit matters, emphasis versus other matters, other information, and wrap up with communicating with governance and the management letter.
Kicking things off on the public stage, we have Section 1, the auditor's core opinion.
Now, when an audit actually reveals a problem, the auditor has to modify their opinion based on two absolutely crucial factors: the exact nature of the issue and just how widespread it is. Think of this little 2x2 matrix as your ultimate diagnostic toolkit. If you find a material misstatement but it's contained to just one specific area, you issue a qualified or except for opinion. But if that misstatement is material and highly widespread, it escalates to an adverse opinion. On the flip side, what if you simply lack the evidence to make a call at all? Well, it's qualified if it's contained, but it becomes a full-blown disclaimer of opinion if the missing evidence is massive and widespread.
Now, you might be wondering, what's the catch? The absolute linchpin of this entire framework is the word pervasive. In our world, a pervasive issue isn't just some localized inventory glitch. Oh no, it means the issue bleeds across multiple critical areas. We're talking revenue, receivables, and cash, all at once. It's a flaw so vast that it fundamentally alters how someone understands the financial statements as a whole. And honestly, missing a pervasive issue, that's exactly how those massive corporate collapses catch investors completely off guard.
So here is your ultimate one-line summary to lock in for the exam. Material but contained equals a qualified opinion. Material and pervasive equals an adverse opinion. And if you have absolutely zero evidence for a massive structural issue, you've got to issue a total disclaimer. It is a very rigid, non-negotiable hierarchy of financial warnings.
Moving right along to Section 2, Key Audit Matters, governed by ISA 701.
For listed companies, you are required to include a KM section in your report. You can think of this as a highlight reel of the absolute biggest risks the auditor faced during the engagement. To craft a solid KM, you have to describe the matter and explicitly state exactly why it was significant. Then, you lay out how the audit team tackled it, listing specific procedures and findings, and finally, you point the reader directly to the related disclosures in the financial statements.
Okay, listen up, because this is a massive exam trap. A key audit matter is never a substitute for a modified opinion. You can't just take a massive, glaring misstatement and quietly bury it in your highlight reel. Actually, scratch that. It goes even further. If you issue a disclaimer of opinion because you lack evidence, you cannot include a KM section at all. I mean, it makes sense, right? How can you highlight significant audit matters when you couldn't even get enough evidence to form a baseline opinion? No way.
Next, we add another layer to our public reporting with Section 3, Emphasis and Other Matters.
You need to know there is a distinct, hard line between an emphasis of matter and an other matter. You use an emphasis of matter, or EOM, to spotlight a crucial issue that management has already properly disclosed in their notes. It's like a company fighting an existential lawsuit that could literally bankrupt them. The EOM doesn't modify your opinion, it just points a giant neon sign at that specific note. On the other hand, an other matter, or OM paragraph, provides vital context that isn't in the financial statements anywhere. A classic example, pointing out that the prior year's financials were audited by a completely different firm.
So it really just boils down to this elegant distinction. EOM spotlights a disclosed matter, while OM provides outside context. Lock this golden rule into your memory, because examiners love to test your understanding of this boundary.
All right, widening our net a bit, let's look at Section 4, Reviewing Other Information.
You know, the auditor's job doesn't end when the spreadsheets close. They actually have a duty under ISA 720 to read the other information in the annual report, like that glowing management commentary right at the front. Why? To play detective. You're hunting for material inconsistencies. Let's say the CEO's opening letter proudly boasts that revenue doubled this year, but your audited financials show it shrank by half. Yeah, you've got a massive problem. You have to request a correction. If management refuses to fix it, you have to consider modifying your report, potentially calling them out with an other matter paragraph. So far, everything we've talked about has been on the public stage. But as we transition to our final act, we really have to ask ourselves, what kind of private conversations are happening in the boardroom before that report ever sees the light of day?
Leaving the public eye, we enter Section 5, Communicating with Governance.
When you're sitting across from the board of directors or the audit committee, timely communication is absolutely paramount. This is your checklist. The auditor has to clearly lay out their responsibilities, flag any potential threats to their independence, and give the board a heads up on significant planned risks. You're also required to present your going concern assessments and point out any weird related party transactions way before that final report gets drafted.
Ultimately, the core philosophy of ISA 260 is simple: no surprises. It's all about ensuring the highest level of leadership is never caught off guard. Transparency happens in this room first, so the board can fix systemic issues before they blow up into very public scandals.
And finally, for our last act, we reach Section 6, the management letter.
Under ISA 265, when you report internal control issues to management, it has to be highly structured. You must clearly describe the specific deficiency, explain the potential ripple effect it could have on the business, offer a concrete recommendation to fix it, and, this is key, capture management's official response to your findings. But watch out for another huge exam trap here, folks. The management letter is exclusively for significant deficiencies. You don't use it to complain about every minor administrative typo, and more importantly, this is a private document. It never, ever excuses a material misstatement in the public report. If a broken control led to a massive financial error, you absolutely still have to modify the public audit opinion. Seriously, an auditor can never use a private letter to cover up a public disaster. It's a fundamental, non-negotiable rule of the profession. Keep this front and center in your mind. By mastering this layered reveal, starting from the very public audit opinion and working our way down to those intense, private boardroom conversations, you finally understand the true weight of the auditor's pen. So here's a thought to leave you with. The next time you flip through a polished annual report, ask yourself, what private boardroom battles were fought before that one, clean, true and fair opinion was finally signed? Thanks for joining me on this explainer, and I'll catch you in the next one.
Welcome to The Explainer. Today, we're transitioning out of the world of basic auditing principles and stepping way up. We're talking about the advanced professional judgment required at the absolute highest levels of practice. We are getting into complex corporate audits, where the stakes are massive, the rules are incredibly strict, and the margin for error is basically zero. So if your goal is to really start thinking like an audit partner, well, you're in exactly the right place.
Here is our roadmap for today. We're doing a macro to micro to macro journey. We'll start with firm quality under ISQM1, then engagement reviews under ISQM2, touch on advanced ethics, professional skepticism, and wrap it all up with group audits under ISA 600.
Section 1. Firm quality, specifically ISQM1. Let's dive right into this macro level.
Now, if you take away just one word here, make it proactively. In advanced auditing, you really can't afford to just react to problems when they pop up. ISQM1 dictates that a firm must have a proactive, living system that is literally designed to stop bad audits and, massive corporate collapses before they even have a chance to begin. It also requires annual monitoring and remediation just to make sure you're constantly fixing any cracks in the foundation. This firm-wide quality system is actually built on 8 core components. Think of it like a giant interconnected web. It covers everything from governance and leadership at the very top, down to how resources are allocated, your risk assessment process, relevant ethical requirements, and how client engagements are accepted in the first place. It guides engagement performance, information and communication, and of course, that continuous monitoring and remediation. It's essentially your ultimate safety net.
All right, Section 2, Engagement Reviews, ISQM2. It helps to think about it this way. While ISQM1 acts as an umbrella for the entire firm, ISQM2 pulls out a magnifying glass. It mandates a specific engagement-level quality review, and this is absolutely critical when you're dealing with listed entities or particularly high-risk audits. This means bringing in an engagement quality reviewer, or EQR, and they need to be a completely independent, highly experienced second pair of eyes. Because of how critical this role is, they absolutely cannot be part of the core engagement team. They can't be subject to any independence threats, and they must have the sheer authority to challenge the audit's most critical decisions. We're talking materiality, fraud discussions, and going concern assessments.
Section 3. Advanced ethics and threats. This is where we pivot to the micro level.
We all know the basic ethical threats, right? Self-interest, self-review, advocacy, familiarity, and intimidation. But here's what's fascinating. When you look at the AAA context, these basic threats upgrade into severe professional dilemmas. For example, an advocacy threat isn't just about casually hyping up a client. It's about being pressured to practically act as their lawyer. Or familiarity? It's not just knowing the client well. It's a 10+ year association that completely blurs your professional boundaries.
And because these threats are so severe, the rules around providing non-audit services become incredibly strict. Sure, some basic tax compliance might be permitted if you have the right safeguards in place, but for listed clients, there are absolute prohibitions. You literally cannot provide bookkeeping, material valuation services, or outsourced internal audits for them. Doing so creates a fatal self-review threat that simply cannot be safeguarded against. No way.
And to further protect that independence, you need to remember this crucial number: 5. For key audit partners working on listed clients, there is a strict 5 years on, 5 years off cooling off period. You rotate off the engagement, period. That ensures a fresh, unbiased perspective is always maintained.
Section 4, Mastering Professional Skepticism. Still at the micro level here.
Professional skepticism is the ultimate behavioral tool you must possess. It's a required forensic mindset. Question, corroborate, verify. You simply cannot just take management at their word. And look, it's not about being needlessly cynical, but it absolutely means you do not assume management is inherently honest. So what does this actually look like in the real world? It's an active three-step process. First up, you have to challenge management's assumptions, especially when they hand you really optimistic forecasts or valuations. Second, corroborate their explanations with external, entirely independent evidence. And third, verify the actual physical existence of assets. Don't just stare at a piece of paper for $1 million machine. Go down to the factory floor and actually point at it.
And finally, Section 5, Group Audits under ISA 600. We're zooming back out to the macro level.
When you're auditing a massive corporate group, there is a clear division of labor, but definitely not a division of accountability. The group auditor takes full 100% responsibility for the final group opinion. They can't just pass the buck and blame a component auditor in their report. The component auditor, meanwhile, executes the audit of a specific subsidiary, but they do it based entirely on strict instructions handed down by the group auditor.
To keep a complex global audit from just completely spiraling out of control, the group auditor has to act like an absolute commander. They mandate specific items down the chain. They dictate the group's accounting policies, enforce strict independence and reporting requirements, and flag related party transactions, as well as any identified significant risks.
And here's a massive point. The group auditor dictates the materiality for the component, and it must be set lower than the overall group materiality. Why? Aggregation risk. If every single subsidiary had errors just sitting right under the group materiality threshold, those are going to aggregate right up at the group level and cause a massive, unacceptable misstatement.
Now let's pose a really high-stakes scenario. Imagine you're the group auditor. You are carrying all of this responsibility. What do you do if management suddenly blocks you or your component auditor from seeing the books of a highly material subsidiary?
The answer is punchy, and it's severe. If you are restricted from access, you cannot obtain sufficient appropriate audit evidence. And if that component is material, well, you have absolutely no choice but to modify the group audit opinion. That means you're issuing either a qualified opinion or a full disclaimer of opinion. And make no mistake, that has severe real-world impacts for the client's market standing and their regulatory compliance.
So we've gone from the macro governance of an entire firm all the way down to individual ethics and skepticism and back out to the massive accountability of group audits. The real question is, are you ready to apply this advanced mindset and truly think like an audit partner? Thanks so much for joining me for this explainer, and I will catch you next time.
Hey everyone, welcome to The Explainer. Today, we are completely shifting gears and decoding the source material on advanced audit investigations. We're leaving the standard, routine external audit in the rearview mirror and stepping straight into the high-stakes world of advanced assurance. Now, this isn't about your basic box ticking or just making sure the numbers add up. Oh no, advanced assurance requires a totally elite investigative mindset. So, you know that standard audits are all about looking for material misstatements to give reasonable assurance to shareholders, right? But what happens when you need to actively hunt down deliberate fraud? For this, I really want you to step into the role of a financial detective. Your job is no longer just to review things. Your job is to uncover exactly what other people are desperately trying to hide.
Let's crack open Case 1, the fraud. We're talking about the forensic audit. This is where accounting literally meets the courtroom in a high-stakes hunt for financial misconduct. And there's a really stark contrast here. In a typical external audit, you rely on sample-based testing to give reasonable assurance, you report to the shareholders, and you generally assume management is neutral. While a forensic audit flips that entirely on its head. It's highly investigative, specifically designed to gather evidence for a court of law or for lawyers. We don't just sample, we do 100% testing on the affected areas. And honestly, the biggest psychological shift is this: we assume fraud actively exists.
To pull this off, you need a seriously different toolkit. The forensic auditor's toolset looks a lot like a true criminal investigation. We rely heavily on data analytics, using mathematical principles, like Benford's law, to spot unnatural anomalies in massive data sets. We use computer forensics to recover files that someone thought they permanently deleted. We meticulously examine physical and digital documents for forgery or subtle alterations. And, crucially, we use advanced interrogation and interview techniques to extract the truth from people who might be actively lying to us. So, if you need one quick summary to lock into your memory for your exams, forensic audit equals investigating fraud for court using 100% testing, data analytics, and interviews.
All right, let's move to Case 2, the criminal. This is all about money laundering and the Proceeds of Crime Act. Here, we step into a realm where you act as a vital shield, literally preventing organized crime from infecting the legitimate economy. First, we've got to define the enemy. Money laundering is the act of concealing the proceeds of criminal activity to make them appear completely legitimate. It's all about taking dirty money and trying to make it look clean. Criminals usually follow a pretty specific three-step playbook to wash this illicit cash. Step 1 is placement, and this is actually the riskiest phase for the criminal, where they physically introduce illegal cash into the financial system. Step 2 is layering. They use these dizzying, complex webs of wire transfers and transactions to totally obscure the original source of the money. And finally, Step 3 is integration. The funds are returned to the regular economy, maybe through buying real estate or luxury assets, so they appear completely legitimate. Because this threat is so severe, your legal duties here are incredibly strict. You have to perform robust KYC, know your client procedures, and that means figuring out not just the corporate shell, but the ultimate beneficial ownership, like who is actually pulling the strings. If you spot something that just doesn't add up, you are required by law to file a SAR, a suspicious activity report, usually to your firm's nominated officer or directly to the National Crime Agency. And pay close attention to this. Failure to report those suspicions is actually a crime for auditors. You carry personal criminal liability if you just look the other way. But listen, there is a massive trap here, and examiners absolutely love to test this. Tipping off is a criminal offense. If you file a suspicious activity report, you absolutely cannot let the client know they're under suspicion. Doing so could alert them to destroy evidence or flee, and it will land you in some severe legal trouble. Let's cement this second case file with a powerful memory hook. Money laundering equals concealing criminal proceeds. The auditor must report suspicious activity, and remember, absolutely no tipping off. Okay, let's pivot for a second to something that feels a bit like a paradox. Think about this. How exactly do you audit something that hasn't even happened yet? Well, that brings us right to Case 3, the future. Prospective financial information, governed by ISAE 3400. We're opening the file on how financial sleuths analyze forward-looking data. And there's a really specific nuance you need to grasp here. Forward-looking info basically comes in two flavors. A forecast is based on expected future events and management's absolute best estimate of what is going to happen. A projection, on the other hand, is based on hypothetical assumptions. It's a what-if scenario. Knowing the difference between those two is absolutely vital when assessing management's plans. So, what exact procedures do we use to test these future predictions? I mean, we don't have a crystal ball, so we have to test the mechanics. We evaluate if management's assumptions are actually reasonable and if they align with historical performance. We rigorously test the mathematical accuracy of their calculations. We assess if the numbers are consistent with the company's overall business plan. And crucially, we must obtain written representations from management confirming their responsibility for these assumptions. Because the future is, inherently uncertain, we cannot offer the positive, reasonable assurance of a standard audit. Instead, PFI engagements only offer limited assurance. We use cautionary, negative language in a report, basically saying, nothing has come to our attention that causes us to believe the assumptions do not provide a reasonable basis for the projection. Plus, we have to explicitly state that actual results are likely to be different. To summarize this future-focused investigation, keep this one-liner in mind. ISA 3400 gives limited assurance on forecasts. Your job is to test assumptions and the math, and always include cautionary language. And that brings us to our final file, Case 4, the secret, due diligence. This is where you dig deep into a target company's closet right before a major deal goes down. Due diligence is a comprehensive investigation of a target company before a merger, acquisition, or significant investment. It is so essential to understand that this is an agreed-upon procedures engagement. We aren't giving a traditional audit opinion here. We are providing factual findings based on a very specific scope of investigation, all to help the buyer make a truly informed decision. Uncovering those hidden corporate secrets requires a massive, multidisciplinary scope. It's really not just about the numbers. Sure, financial due diligence looks at historical performance, assets, and hidden liabilities. But we also look at tax to find compliance exposures. We review legal, digging into contracts and any ongoing litigation. We assess operational realities, things like IT systems and supply chains. We even look at environmental factors, hunting for contingent liabilities like unrecorded pollution cleanup costs. As the financial sleuth here, you're constantly on the lookout for major red flags to protect the acquiring company from buying a total disaster. You're going to calculate normalized earnings by stripping out sneaky one-off gains management might have included just to inflate the price. You identified the true, ongoing working capital requirements. You hunt vigorously for off-balance sheet liabilities that standard audits might totally miss, and you expose related party transactions that just don't reflect true market reality. Let's lock in our final exam trigger for this case file. Due diligence equals investigating a target before an acquisition, and it spans financial, tax, legal, and operational boundaries.
All right, time for the auditor's verdict. Let's wrap up these case files.
We have covered some serious ground today, bringing 4 incredibly powerful investigative disciplines together. Whether you are performing 100% testing in a forensic fraud hunt, shielding the economy from money laundering through strict SAR reporting, testing the mathematical assumptions of the future under ISA 3400, or tearing through a target company's secrets in due diligence, mastering these 4 areas transforms you from a standard accountant into a high-level business protector. You've now got the mindset of a financial sleuth. The only question left is, are you ready to catch what everyone else misses? Keep this structured approach in mind, apply it to your studies, and you'll be absolutely unstoppable.
Listen to me closely. If your ACCA exam is literally days away and you're feeling totally overwhelmed, just stop right now. Take a deep breath. You are in exactly the right place. Welcome to this Masterclass Explainer. I'm here to execute a rapid-fire, completely no-fluff rescue mission to get your brain locked in and exam ready. We're cutting out all the noise, dropping the textbook filler, and focusing exclusively on the high-yield, pure signal concepts that are going to drag you across that pass mark. So I need your absolute, undivided focus for the next few minutes. Let's get into it.
I want this to burn into your memory right now. You will learn more from your mistakes than from any notes. Listen, this isn't just some cheesy motivational poster. This is your absolute battle cry for these final hours. Stop passively reading endless pages of text. The ACCA examiner is not going to test your ability to highlight a textbook. No way. They are testing your ability to navigate their traps. And honestly, the absolute fastest way to learn how to dodge those traps? Fall into them right now, figure out exactly why you fell, and make sure you never, ever do it again.
So here is our 3-step game plan to get you exam ready. Number 1, ultra-fast revision. Number 2, common exam mistakes and fixes. And number 3, practice strategy. Let's kick things off with Section 1, ultra-fast revision. All right, shift your brain into top gear right now. No more long paragraphs. We are hardwiring one-line triggers into your mind so they fire off automatically. Boom, adjusted present value. If you're sitting advanced financial management, this is an absolute must-know. APV literally separates the operating NPV from the financing side effects. You need to instantly generate this formula in your head. Base case NPV plus the present value of the tax shield on debt minus your issue costs plus the present value of any subsidized loan benefits. Drill that exact sequence. Base plus tax shield minus issue plus subsidy. Lock it in.
Okay, let's see how fast we can trigger your recall across different papers. Ungearing beta, you're removing financial risk using 1 minus the tax rate. Target costing, it is always the target selling price minus your desired profit, and you absolutely must close that gap with value engineering. Throughput, it's simply your sales revenue minus direct material cost only, and your entire goal is to maximize it per bottleneck hour. Lock these associations into your brain immediately.
Now let's talk relevant costs. These are strictly future incremental cash flows. I honestly cannot emphasize those 2 words enough. Future, incremental. You know, the examiner absolutely loves to bury sunk costs, like market research you've already done or machinery you've already bought, deep into the scenarios just to waste your time and destroy your calculations. Listen to me. If it's already spent, it is sunk. Ignore it completely and move on.
Let's keep this intense pace going. Notice how quickly we can switch contexts here just to prove your memory works. In advanced performance management, dysfunctional behavior means gaming the system, short-termism, or budgetary slack. Now, switching to tax, BAR-DR, that's business asset disposal relief, means a 10% rate up to a $1 million lifetime limit. Back to PM, shutdown decisions. We only shut down if the avoidable fixed cost savings are strictly greater than the lost contribution. Snap, snap, snap. That is exactly how fast your recall needs to be.
So, why do good students fail ACCA exams? Think about that for a second.
I mean, they know the formulas, they've read the books, so why do they get 48 or 49% and fail? Well, it's because they walk blindfolded right into the examiner's favorite traps. Let's fix that right now.
Which brings us to Section 2, Common Exam Mistakes and Fixes.
This is your ultimate shield. We're bringing the energy right back up to maximum, because here is where you secure those extra 5 to 10 passing marks that will literally flip a fail into a solid pass. A classic, heartbreaking rookie error in APV calculations is using the WACC to discount the base case NPV. Doing that drops easy marks instantly. The brilliant fix? Base NPV must always be discounted using the ungeared cost of equity, or KE. Do not let financial leverage contaminate your base case. Separate it out.
Now here is a massive trap in performance management. The mistake is spotting a target costing gap, doing the calculation, and just stopping. You calculate the gap is $10 and you move on. No! The fix here is you must always recommend value engineering actions to close it. Standardize components, substitute cheaper materials, simplify the design. If you stop at the math, you're literally leaving half the marks sitting right there on the table.
So the crucial point here regarding divisional performance is this absolute examiner favorite. The mistake is blindly trusting return on investment, or ROI. You see, ROI tricks managers into sub-optimization. They'll reject a great project just because its return is slightly lower than their current division average, even if it completely beats the corporate cost of capital. It's crazy. The fix? Use residual income, or RI. RI gives you an absolute monetary amount and is the ultimate savior for making decisions that actually align with shareholder value.
Okay, if you're taking the UK tax paper, do not ever mix these two up. The mistake is treating exempt VAT supplies as if they're zero-rated. They are totally different beasts. The fix is knowing that zero-rated means the tax rate is 0%, but you can still recover your input VAT on purchases. Exempt, on the other hand, means there is absolutely no input VAT recovery allowed. Hit that distinction like a hammer in your mind so you never, ever mix up input recovery rules again.
Moving on to our final phase, Section 3, Practice Strategy.
We're shifting from defense straight to offense. You have the rapid-fire triggers, you know the traps, but how are you actually going to spend your final 48 or 72 hours? I need you to follow these 3 exact steps. Step 1. Attempt the objective test questions and mocks in the ACCA free practice platform. Step 2. The timer is on. No pausing to check a textbook, no pausing to grab a coffee. You absolutely must simulate the brutal reality of the exam hall to build your stamina. And step 3, review your mistakes deeply, because honestly, that is where the actual learning happens.
I want you to screenshot this golden review template right now. Seriously, do it. For every single question you get wrong from here on out, you're going to do a forensic breakdown. What was the question? What was your answer? What was the correct answer? Why were you wrong? Was it a math error or a concept gap? And finally, what is the fix? If you use this framework for everything, your scores will absolutely skyrocket.
Now, let's look at this incredible rule and really build your confidence. Show all workings. Even if the final number is completely wrong, method marks count. Listen, the examiner is not your enemy. They actually want to pass you. If you multiply by the wrong tax rate in step 1, but your logic for steps 2, 3, and 4 is perfect, you are getting those marks. You just have to show your logical steps. Do not just write down a naked final number.
Here is an exclusive insider tip just for you in these final, high-pressure days. Take screenshots of the MCQs you get wrong. Create a dedicated album on your phone. Then revise them every single morning the minute you wake up and every single night right before you go to sleep. What you're doing is training your brain's pattern recognition. When you finally sit in that exam hall, your brain will instantly recognize the shape of the questions that used to trick you. It's a real game changer.
0. There is absolutely zero negative marking in ACCA. You must never, ever, under any circumstances, leave a question blank on the practice platform or in the real exam. If you're down to the last 10 seconds, just guess. A blank answer is a guaranteed 0. A guessed answer? That's a 25% chance of a mark. Leave nothing blank.
Okay, take a deep breath. You have the tools, you understand the triggers, you know the traps, and you have the practice strategy. Now, you just need to apply them with absolute confidence. The hard work is already done. Now, you just need to execute. Go in there and pass this exam.
So I leave you with this final provocative challenge. Will you let the examiner's traps beat you, or will you use your mistakes right now to guarantee a pass? Get off this explainer, log right into the practice platform, start that timer, and go attack your mock exams. You've totally got this.